Let's kick off this explainer by unpacking something pretty wild. Hormel Foods, a company that's literally been a staple in our pantries for over a century, is completely ripping up its playbook for 2026. They're shedding those old, unpredictable commodity roots and sprinting toward becoming a modernized, value-added protein powerhouse. To really grasp the magnitude of this pivot, you kind of have to understand their foundation. 398. That is the number of consecutive quarterly dividends Hormel has paid out. It's almost hard to wrap your head around. Through market crashes, recessions, changing consumer diets, they just keep returning value. That level of stability is exactly what makes them a true dividend aristocrat. But they aren't just resting on those laurels. Management made this super clear recently. John Genko, Hormel's president, flat out said that protein isn't some passing fad. It's an enduring, long-term movement. They know that to survive and thrive for the next 100 years, they absolutely have to go where the modern consumer is going. So here is our roadmap for today. 1. The protein powerhouse pivot. 2. Q1 2026 earnings snapshot. 3. The strategic turkey divestiture. 4. Overcoming industry headwinds. 5. Who owns Hormel? And 6. The road ahead. Let's jump straight into Section 1, the protein powerhouse pivot. Is all about solving actual problems for consumers and restaurant operators. Take their Flash 180 chicken tenders, for example. Chicken tenders are on roughly 40% of all restaurant menus right now. So Hormel created a crispy, high-quality solution that drastically cuts down prep time for kitchens. Genius, right? Or look at Spam Chicken over in Asia. They took an absolute icon and evolved it into a wildly popular chicken format in cans and single-serve pouches. And their Black Label oven-ready bacon? It's crushing it online, driving 60% of its sales through e-commerce, because younger buyers just want a convenient mess-free tray. It is totally intentional innovation. Now, this entire growth engine is powered by their internal Transform and Modernize initiative. Basically, it's a massive end-to-end supply chain overhaul. Right now, they're moving past the messy foundational implementation phases, and the facilities using this new model are running way more efficiently, which is absolutely crucial because it frees up capacity on their core lines to actually manufacture those high-demand, value-added products we were just talking about. Moving to Section 2, Q1 2026 earnings snapshot. So, the big question, is this strategic pivot actually working? Well, the Q1 data provides the proof. Net sales ticked up 2% to push revenues over $3 billion for the quarter. That makes it their 5th consecutive quarter of organic top-line growth. But the real standout here is food service. Even with restaurant operators being super cautious lately, Hormel just hit its 10th consecutive quarter of organic net sales growth in food service, with prepared proteins and branded pepperoni doing the heavy lifting. Taking this straight from the Q1 call, interim CEO Jeff Ettinger basically said their protein-centric portfolio is their secret weapon. By giving food service operators easy solutions and retail consumers quick convenience, they're effectively insulating themselves from the broader industry-wide consumption slowdowns. Up next, Section 3, the strategic turkey divestiture. This is where the overarching strategy gets really sharp. Hormel recently agreed to sell off its whole bird turkey business to Life Science Innovations, but it's a surgical cut. They are only selling the whole bird female hens, the ones you typically eat at the holidays, along with the Melrose facility and Swanville feed mill. What are they keeping? The highly profitable, value-added Jennie-O male turkey operations. They keep the brand, they keep the oven-ready products, and most importantly, they keep those high margins. To put that into perspective, Hormel is willingly stepping away from roughly $200 to $275 million in annual revenue. Why on earth would you give up that much cash? Because that specific whole bird revenue stream was tied to highly volatile commodity markets and razor-thin margins. They are literally trading top-line vanity for bottom-line sanity, exiting the commodity game to protect their overall profitability. All right, Section 4, overcoming industry headwinds. Of course, it wasn't all sunshine and rainbows this quarter. The retail segment took a hit, with organic volume and net sales dropping. Now, part of that was actually self-inflicted, a strategic exit from some non-core private label snack nuts. But the real headache came from the supply side. Beef prices remained stubbornly high across the board, and pork trim input costs spiked a painful 12% compared to last year. Throw in some severe winter weather that tightened freight capacity and drove up unexpected logistics expenses, and you've got some serious margin pressure. So how do you fight back against those soaring input costs? You pull the pricing lever. Management confirmed on the call that they successfully rolled out a second wave of retail pricing right at the start of Q2 to ensure those commodity spikes don't derail their bottom line recovery.
Let's look at Section 5. Who owns Hormel?
It's always fascinating to peek under the hood and see who's backing the play during a big transition. And Hormel, it's basically a financial fortress. Foundation Hormel holds a staggering 46.6% of the shares. That's over $6 billion worth of equity. Add in institutional investors holding another 45%, and what you get is incredible stability. There is no room here for activist investors to swoop in and demand a quick, short-term buck. This ownership structure perfectly aligns with and protects their patient, long-term turnaround vision. And if you're wondering how the ultimate insiders feel about this strategic pivot, just follow the money. Look at this heavy wave of stock buying at the end of March 2026. You have multiple directors, Stephen Andrew White, Gary Bojwani, William Newlands, and Christopher Polinsky, all stepping up and buying thousands of shares on the open market. When the leadership team opens their own wallets during a massive corporate restructuring, it signals deep, deep confidence in the game plan.
Finally, Section 6. The road ahead.
Even with the retail hiccups and that nasty 12% inflation on pork trim we talked about, Hormel is holding firm on their full-year guidance. They are confidently projecting up to 4% organic sales growth and an impressive 4 to 10% jump in adjusted operating income. A big part of this confidence comes from the expectation that those brutal commodity costs will finally start to cool off in the back half of the year, all while they deploy up to $290 million in capital expenditures to keep modernizing their footprint. In the immediate short term, looking at Q2, they expect to see sequential improvement. As the financial benefits from their internal restructuring and that new second wave of pricing actually hit the bottom line, they project top-line growth to continue. They see earnings per share coming in flat to maybe slightly up compared to last year. It's a slow, steady, and highly deliberate rebuild. Which leaves us with this final thought. We are watching a 130-year-old institution intentionally shrink parts of its business just to grow its margins. As Hormel decisively sheds its volatile commodity roots to dominate the high-margin, consumer-led protein space, you really have to ask yourself, is this dividend aristocrat's biggest growth era actually just beginning? Thanks for tuning into this explainer. We'll catch you next time.